Well, this is Current Yield, Grant's Interest Rate Observer of the Air. I am Jim Grant. With me, as always, is Eric Whitehead, our technician at the dials. And speaking to us from the borough of Brooklyn, New York City, is Evan Lorenz, the great deputy editor of Grants. Phil Grant, who edits our indispensable daily summary of all things financial, his almost daily Grants, is he's working, he says. That's a good place to be, working, but not with us. But he is hard at work on producing another issue of ADG. And Evan, you're in the borough of Brooklyn. Are you about to be locked down by the mayor of the city of New York, or are you all good?
Not this week, but ask me again next week.
Okay. Ladies and gentlemen, we have a mayor named Bill de Blasio, and he is known in the pages of the New York Post as Blas, as in B-L-A-H with an S at the end. And I think that's a kind of an appropriate moniker for headline. But Mayor de Blasio has just threatened lockdown on certain non-compliant zip codes in New York City. And I would say this is only middlingly bullish news for Grant's Interest Rate Observer. We're going to have our conference on October 20th in Manhattan. We are calling it Contrarian's Ball. And I had no idea, Evan, how contrarian we were going to be by having a live event in the city of New York under the mayoral supervision of Blas in the fall of 2020. I mean, is this beyond contrary? This is seeping into quixotic. I got to admit that. But I said that zip codes reminded me of this contrarian's ball, and here is the reason. Because we are having it not at the plaza, which is our want, has been our want for more than 30 years. We're having it at the Javits Center, which is this immense, cavernous conference place on the west side, West 34th Street. And I'm thinking that, Eric, you've been there and recently checked it out, but I'm thinking that you can be seated at one end of the Javits Center and not be in the same zip code as a fellow conference attendee. Is that correct? Yeah. So there's plenty of room to colonize. You can bring your whole family in there and colonize one segment of the Javits Center and never see, let alone make physical contact with others. So, oh yes, I forgot to mention this podcast is brought to you today by Contrarian's Ball. I guess that would have to be self-evident if I went on much longer. But it's not only this self-aggrandizing advertorial that brings us here today in your presence, listeners. It's our guest, who is John Haskell. He's an old friend of mine. No, he is a friend of mine of some long-standing. John Haskell is not old. And I met him at the Harvard Business School not so many years ago. I myself was not in attendance at the Harvard Business School. That was John Haskell. And he was, I think, if not the president of the investment club, then at least in charge of summoning guests to speak to the investment club. And they got to the bottom of that list. And I found myself at the Harvard Business School addressing John Haskell's colleagues, and very honored to be there. So, but John graduated. Am I right, John?
That's right. I graduated.
Yeah. Okay. And went on to investment career that is just beginning. He spent 5 years as a lead analyst at Explorador, which is an equity fund that invests in Latin America principally. And so he had a deep grounding in emerging markets, and now is bringing forth his own fund. He's calling it ATLA, A-T-L-A, and it is to specialize in emerging markets real estate, especially real estate situated in urban centers. So, ladies and gentlemen, this is a proposition, like the Contrarian's Ball, that is bleeding into the realm of the quixotic. I submit this to you. He's going to be long the following things, or investing in the context of the following things: COVID-19 shock, the lost decade, so-called, of the emerging markets, and perhaps the most contrary of all, he has got an idea that inflation is not dead and decomposing, but merely resting. So, John Haskell, with that somewhat verbose introduction, welcome to Current Yield.
Thank you, Jim. Thank you, Evan. Thank you all for having me.
Hey, John, how far back do the index records go showing that emerging markets affirmatively and historically outperforms developed markets?
It's a complicated question because actually the overall Latin American index, for example, which was one that I spent a lot of time focused on as my benchmark at Explorador, that one goes back to the 80s. And the MSCI larger emerging market index has a different start date, and there's also competing indices by different providers. So there's no easy answer, but you can get a few decades.
So it's
track record.
Right. It's an observed tendency over several decades rather than an iron law.
Absolutely.
Yeah.
And whether the past is any indicator of the future is up for constant reevaluation.
Right.
I would say.
So, John, your fund is of course a partnership. It's for so-called qualified investors, but you'll be dealing in public equities. No, so this opportunity is available to everyone, especially, of course, those who avail themselves of the new ATLA fund, which is debuting perhaps in December. But the components of your fund are in the public equities domain. No,
that's right. There's been a change in capital markets in the last few decades. What has really matured is the space for publicly traded real estate. Those are REITs, real estate investment trusts, but also regular C corps that happen to own and operate assets with recurring income. And those property stocks, that universe, was small and esoteric, but with REIT legislation passing in countries overseas and just with the expansion of public equity markets, it's now become relevant. It's a market of size.
So, John, one of the trends you mean to hitch onto is urbanization. And of course, this podcast is coming to you from the city of New York, Mayor William de Blasio, Mayor. And New York City seems to be in a bit of a pickle. What with no one coming to work in these fine office buildings and a real estate investment trust called SL Green having sawed in half, I think, in price since the start of the...
Yeah, relative to its estimated net asset value, it's trading about half that value.
So, which raised the question, John. So, when you can have SL Green here in the United States with the rule of law, or what remains of it, why venture abroad?
Right. Well, first of all, as we've discussed in the past, everything is a function, risk is a function of price. And in the basket of legacy cities, New York, London, Paris, San Francisco, Tokyo, the two-bedroom apartment you can buy in the city center per square foot is about $1,500. The equivalent apartment per square foot in a basket of cities abroad that are emerging, cities like, Dubai, Ho Chi Minh City, Jakarta, Johannesburg, Sao Paulo, a basket there is under $300 per square foot. Your rental costs per square foot of, prime central business district office space, you're paying a little less than $200 per square foot per year in this prime legacy city basket. And you're spending about $50 per year in this other basket. So on a fundamental basis, real estate in emerging cities where populations are growing at a double-digit percentage increase each decade, prices for real estate in those cities is far less demanding, 3 to 6 times.
So, John, you implicit in your thesis is the ancient epigram, "This too will pass." No, with respect to, say, COVID and pandemic.
That's right. COVID is the current entry, but there's really also a long-term secular tailwind. And I don't want to focus too much on the entry point when this is meant to be a portfolio for the long haul. And I think what's exciting here is that this universe of publicly traded emerging market stocks, which very few people focus on, spans nearly 40 countries and accounts for about 3/4 of human population. And when you look at human population, the growth over the next few decades is entirely urban. In fact, the world's rural population is expected to plateau in 2021, 2022. And so all incremental growth of the human population is through a function of internal migration and just sheer population growth is urban. And if you look at where that urban growth is occurring, the increment is almost entirely emerging market urban. So the basket of cities or the places that we're debating, is the city dead? New York, for example, or London, there can be a pitched debate about it. And in the long run, I would argue strongly for New York. But it's a city that also is facing a budgetary crisis. It has rich valuation. There's wealth levels per capita that allow people to contemplate moving to suburbs.
So, right. So Ho Chi Minh City is cheaper than New York City, but if you go for the cheap place, you find that you're in Ho Chi Minh City. I mean, there's a spread that's kind of logical and warranted, no?
No, there should be a spread. The question is the spread correctly priced, or is it too wide? And what I would say is, for the largest investors in the world, they're already comfortable with having a portfolio of buildings around the world, because that portfolio diversification provides some resilience. If you're the Norwegian Sovereign Wealth Fund, then you're invested in Berlin office towers. If you're GIC out of Singapore, you own a portfolio, including the Time Warner Center in New York, residential tower complexes in China. So the largest investors understand that real estate is risky, and there's diversification benefit to a portfolio. But for individual investors, small investors, how would one access this in the past? Right? You can't go and buy individual.
John, how about giving us a couple
towers.
for instances? Give us an example or two or three of a publicly traded, not too thinly traded, but publicly traded equity that has exposure to the things that you're talking about, and give us examples.
Sure. This is my territory now, bottom up. So we've discussed in the past Urbanization in Mexico. I think Mexico is very interesting right now, has a few really quite compelling opportunities. But let's go somewhere different. Let's go to Indonesia. Indonesia, fourth populous country, 270 million people. GDP per capita, about 4,000. The currency is inexpensive on a PPP basis. It's got a triple B credit rating. It's like Mexico in that regard. There's a company there called Pakuwon Jati. It's a real estate developer and owner of malls.
Can you spell that,
towers,
John? John, can you spell it?
Sure. Pakuwon, Pakuwon, space Jati. The ticker is PWON, and it trades on the Indonesian.
Wait, spell out the acronym more slowly so people can write it down if they want to.
Sure. Pakuwon Jati, and the ticker is PWON.
PWON. Okay, P1. All right.
And it trades on P1. Yeah. So Pakuwon Jati, it's a $1.1 billion market cap company. It's down 50% year to date. It was cheap at the beginning of the year. It's down by 50%. It had a 36% decline in recurring revenue because of COVID. This is a company that owns, again, malls in downtown Jakarta and Surabaya, which is the second largest city in Indonesia, fast-growing industrial city with good urban planning relative to Jakarta. The company manages these core downtown malls, the Pakuwon Mall, the biggest in Surabaya, for example. They also have office towers with very blue chip companies in them, AIA, the LG headquarters, Bank of Tokyo in Indonesia, HP. And then they also have a portfolio of hotels, the Sheraton Grand in Jakarta, the Sheraton Surabaya, pretty soon a Westin. So this is a company that for years has developed buildings, owns and operates them, and harvests recurring yield. They also have a land bank, and they develop that bank into residential projects. Right now they have 450 hectares of land, which is about 1,100 acres, which means it's like 1.3 times the size of Central Park, just in raw land.
How's this thing valued, John?
If you just take the mature existing recurring revenue portfolio, that is 8.4 million square feet of malls and office towers. And so you're talking on an enterprise value per square foot of $158 or $160. There's also a portfolio of hotel rooms that's not even factored there, and there's the land bank, and all of its development potential. Take a yield basis. So on 2019 numbers, and this is, of course, when there was travel and there was not social distancing, and so things are quite different. But take 2019 as a snapshot of a normalized year. On 2019 numbers, it has a 10.7 cap rate right now. And so what that means is you're buying existing assets at a discount. I would say having a double-digit cap rate is appealing. Double-digit free cash flow yield is appealing. And yet you're paying nothing for 1.3 Central Park in sort of an assemblage of land, primarily in Jakarta and Surabaya, where there's land scarcity to an increasing extent. This is also, just to quickly note, sorry, Evan, is that it's practically unlevered. The net debt to equity here is 2%, maybe net cash this year. So there's no leverage, which means even if I am wrong about when a mall will return, or even if some of their assets are obsolete, which I don't think is the case, then the underlying impairment or potential for underlying impairment to equity is low because of how unlevered it is.
Okay, John, when you invest in REITs overseas, you're not investing directly in real estate. You're investing in a management team who invest in real estate for you. How would you rate management teams over there? And I'm not trying to say that emerging market management teams are any worse or better than the U.S. The Wall Street Journal last week had an article saying that shale CEOs had some of the fastest pay rises over the last 5 years, despite generating some of the worst absolute returns in the S&P 500.
Interesting. I would say, like other asset classes, it's a good point. The issue here is who are the operators and what is their competency and what is their alignment. And really, competency and alignment explains a lot of good and bad behavior out there. I felt that in Latin America, or saw that in Latin America. So real estate in this case is, like you said, buying into a portfolio managed by management teams on the ground. Part of why one can build a portfolio across different countries is you have these management teams that are well established, that have listed their portfolios and have audited financial track records over time, and you can get a sense of folks for their reputation as well as their history. In many markets, the key here is to understand where there's a misalignment of interest, where controlling shareholders, either through one way or another, different share classes or related party transactions, are not in the service of all shareholders, minority.
So I take it, John, with respect to Pakuwon, you are satisfied that these people are upstanding and properly aligned and competent?
Yes, I think Pakuwon Jati is an example of a best-in-class operator. I mean, this is a business that came out of a family franchise out of Surabaya. The wealthy family that is bought into the business is named Teja, T-E-D-J-A.
Okay.
And he's sort of a giant in that industry, in that economy.
Speaking of giants, John, speaking of giants,
yeah.
I would like to remind the listeners to Current Yield about the fabulous lineup of gigantic speakers we have for the October 20th event at the Javits Center. You say giants? Yeah.
Who do we have?
Yeah.
Who do we have?
Well, we have Mervyn King, the former governor of the Bank of England. We have Jim Chanos, the great short seller. We have Bruce Flatt, who was a real estate man of no small distinction. And we have Stephanie Kelton, who is going to sing the praises of modern monetary theory. We have Dylan Grice, who is an investment strategist par excellence. We have Monica Erickson speaking about corporate credit, investment-grade corporate credit, and Cy Jacobs concerning investment opportunities in and around financial stocks, and Joe Lawler. A taxonomy of COVID shorts is Joe Lawler's topic. And last but certainly not least is the great, indeed gigantic John Paulson speaking to the topic gold coming to a theater near you. Now, I put it to you, John Haskell, is this not value? I mean, come on. This is a fabulous lineup. So please, ladies and gentlemen, I think Eric Whitehead, even now, is sitting around waiting for your telephone call to sign up for this event. Go online, just look us up in the yellow pages, Grand Central Rate Observer. Sign on to our fabulous website. And I guess that will conclude this sponsored message. John, you were talking about, if I remember, before you were talking about opportunities in the urbanized real estate segment of emerging markets, and you gave us this one very fetching opportunity in Indonesia, Pakuwon. How about one more? Just the highlights of another stock that might be representative of the kind of opportunities that you were availing yourself of.
I would bring it back to Mexico, because I think there we could, for example, talk about Ciudadanos, which reminds me so much of Pakuwon Jati in Indonesia in a few key respects. Right, it's the recurring income, low debt, and owning assets that have scarcity. Right, trophy assets in very downtown land that is irreplaceable, where the long-term upside from owning that is really quite compelling. So this company, Danos, D-A-N-H-O-S, Fibra Danos. Fibra is the Mexican term for REIT. This one is a REIT, and the ticker is Danos, D-A-N-H-O-S 13, which is Mexico's convention of putting the year of the IPO at the end of a REIT that's locally listed. So Danos 13 on the Mexican Stock Exchange. And we've discussed this one before. It's a business that is down by over a third this year in dollars, $1.4 billion market cap. They have 9.6 million square feet of GLA. Pakuwon Jati, if you recall, they were about if you go to Mexico City and you get into a taxi or an Uber and you say, I'm going to the Dorito Tower, everybody knows what you're talking about. The Dorito Tower is an upside-down triangle that looks like a Dorito chip.
Can you have just
ground.
one?
Well, there's only one of the Dorito Tower, and that's the point. It's in Polanco, which is a very classy downtown part of Mexico City. It's such scarce and valuable land that they have parking that I think goes down 14 stories, which makes it one of the deepest parking lots in the world. And obviously, excavating that is expensive. So it just shows how prime that tower is, how prime that land is. It reminds me maybe of the GM building or something in New York City.
I want to ask you about how a manager goes about managing such a far-flung portfolio of stocks. So, do you live out of a suitcase, or do you plan to once you get going on this thing? You're going to go to spend a week at the Sheraton in Jakarta and then hustle on back to Mexico City to avail yourself of the opportunities of parking at the 14th level beneath the surface of the earth? How do you physically supervise a portfolio that spans the globe?
Well, the short answer is yes. I live a bit out of the suitcase because there's real value to going to these places and going regularly to these places, not as a one-time tourist, but as a recurring visitor, meeting with management companies, meeting with the local brokers. That is the work on an ongoing basis. COVID and work from home, and will there ever be an office again? That whole debate actually worked really to my advantage, because for those companies where you already have an existing relationship, jumping on a Zoom can be very effective. An hour-long meeting, an informational exchange once a quarter, has been easy to do over Zoom. That doesn't replace being there in person, but it's a nice supplement. And maybe in the future, one outcome of all this is I get to get on fewer airplanes. But it seems doable, just given, frankly, the quality of the management teams that I can identify in these different markets. And so joining them for a day once a quarter or every 6 months is a very effective use of time.
Oh, all right. Well, John Haskell, this has been very interesting, illuminating, and indeed exciting. Exciting because it's, I always feel a vicarious thrill talking with an entrepreneur on the verge of creation of his or her vision. And goodness knows
Thank you.
I'm sure you've been thinking about this for years and years, and now it's upon you. And you're, I've always found the difference between being an employee, even a senior employee someplace, and owning the joint is a difference between sleeping at night and not sleeping at night. No, that's okay. That's only one aspect of it. But it
already flows now, and I'm super glad to be embarking on something very entrepreneurial. And you're right, this was like the time when there's blood in the streets, the moment. A lot of the world has recovered from COVID in terms of market valuation. Tech sector is roaring. But I have to say, in my small corner of markets, the window is still super compelling, and the dislocation has not corrected itself.
Well, break a leg. No, I'm going to go further. Break 2 legs. And in the day and age of Zoom, I don't think that would be debilitating. Just you can just stay in front of your tube. So on behalf of the great Evan Lorenz of Brooklyn, New York, and Eric Whitehead of Smithtown, Long Island, New York, and me, Jim Grant, the editor of Grant's Interest Rate Observer, a little bit now of Schoharie, New York. Thank you for listening. And John Haskell, it has been a delight. It seemed like only yesterday when you were at the Harvard Business School, and I was
It does seem like yesterday.
What fun. Yeah. Anyway, you go get them. It sounds like a wonderful opportunity. And, don't be a stranger. Check in from time to time and tell us how much you're up.
Sounds good. I appreciate your time.
Okay.
Thank you so much for having me.
Talk soon, ladies and gentlemen. Thank you for being with us on Current Yield Grant's Interest Rate Observer of the Air.